A very warm welcome to the Trading Mentor, dedicated to your success. In this video we're going to be talking about adding and plotting a trend, what indicators to use and how to use them. Before we go on, just a quick disclaimer. We'll get live into the charts and show you how to add on the indicators. So just to let you know that all the information that we give is for educational purposes only. It's up to you to do your own research and to make your own decisions. We do not offer any investment advice. So a very warm welcome to the Trading Mentor. As I said before, this is all about adding on the indicators so that you can establish and make informed decisions about a trend. This is the US yen, for instance, and there's been some trading opportunities along the way. So let's add on some indicators to help us decide which direction this is going to go. The first one is a moving average. It's a 7 moving average. I like red. You can choose whatever colour you like. And so that's one of the indicators. Hopefully, once we've got the indicators on, you can see which direction it's likely to continue to go. And all we're doing is putting the probabilities in our favour. So here's the first set of indicators, if you like. The faster moving average, the 7, above the slower moving average, the 20, indicates a continuation of a trend. This can work on any time frame. It can work in any market, indices, gold, oil, stocks and shares. And as you can see at the moment, price is 108.04. It's in a downtrend. Let's add another indicator to help us along our way. Now remember, none of these indicators work on their own. They all work in conjunction with each other. So that's the MACD. Moving average convergence divergence. This is one that we use quite a lot. Again, it cannot be used on its own. So again, when the red line falls below the blue line, the slower moving average, then this indicates a trend is likely. Here, for instance, back in March, you could see that the price was trending, beginning to trend. The next one is what we call a parabolic support and resistance indicator. I call it stop and reverse. Hopefully you can see that. That's not the best colour, is it? You can see at this point here, for instance, back in March, we would have had a trade and the MACD confirmed a buy. The moving average confirmed a buy. And the parabolic stop and reverse confirmed a buy. So there's about 200 pips there. And don't forget, we're not here for 20, 30 pips. Many people I've noticed are looking to scalp the market and get a quick 30 pips, 20 pips. It's a complete waste of time. Get into the trend. The trend is your friend. Here's another one. Back in February, 353 pips. Doesn't always work as good as that, but nonetheless there are lots of profits to be had with the trends. Currently 252 pips on that downtrend. Now, one of the things we use the MACD for mostly is divergence. Negative divergence, positive divergence. Now, we're not in this position because we've spotted some divergence here. And there's a whole course on divergence, but I'll just give you a quick so the MACD histogram is going up, yet the price is going down. This indicates that there is highly likely, probably, going to be a reversal. One more indicator. Use a slow stochastic. And the settings are 14, 7 and 3. I'll make the lines bolder for you so you can see clearer. Normal settings of 80 and 20. Enlarge that for you. And just to explain how the stochastic works. At the point of entry, we want to make sure that the stochastic, let me just highlight a few points here. I'll go over these any second. Okay. So at the point of entry, all indicators must agree. First thing, MACD, moving averages, parabolic, and the stochastic must be pointing in the right direction you want to go, and it must be in neutral at the point of entry. So for instance here would have been great. Here we had a buy signal on the moving averages, buy signal on the MACD, but at this point here, quite quickly the stochastic was overbought. You don't want to get into a position when it's overbought because the chances are it's going to come back on you, even stop you out at some stage. So the safer entry is to get into a position where the stochastic is in neutral. Hopefully that makes sense. Now when it goes overbought, you don't necessarily exit the position because quite often the stochastic is overbought in an uptrend, which we can see here, along that way there. You ignore it completely. At the point of entry, we want to make sure that it's not overbought if you're buying. And there you have it. That is the setup. Now there's more to this, of course. If you go through the 10 courses, I think I've written some more now, so there's more courses on the members website. For instance, here we talk about breakups, flags, wedges, which are an important factor in getting into a position if it's going to change trends. Okay, so we do need more detail before we enter, but nonetheless, this is a great setup to get you into a position. The other thing which is really important, it doesn't get you into a false position. It avoids getting into a position early. It avoids getting into a position where it's likely to go the other way. Hopefully that makes sense. So it keeps you out the market when it's not safe to do so, but gets you into the market when it is safe to do so. And if you come on to my Telegram instant messaging site, then I will post charts out every morning to see what I'm looking at, what's going on, what the potential is, where there's divergence. Divergence is very powerful and gets us into a position much earlier. So hopefully that's helpful, and you can plot your charts now and let me know how you get on.